Muni bonds or just munis or just bonds in general? Muni bonds. Anything else? We got a couple minutes here. We'll give everybody in a minute or two to get into the thing. I don't do Kaplan QIDs here because I have to look it up and I don't want to change the screen. But what you can find is I will make a video of that and post it on the channel either tonight or tomorrow morning. So 126-3897. All right. So that will show up in the channel as a video explication either tonight or tomorrow morning. The one you're going to get, Erica, is accretion going downwards. I'll show that to you. Listen, I also noticed that some of you, I didn't recognize you being in the live stream. This is not for a separate thing. So if you're not participating in the live stream, at some point, I will not allow access to the overtime session because then it's not an overtime session, right? So the deal on the live stream overtime is you have to first participate in this evening's live stream. So if you don't do that, then this is really not something that should be available to you. Okay, that's fine. We'll just knock them out in the thing how we get them. All right, well, let's start with, let me get a screen here. I debate, Erica, whether I should show this to you because you might end up getting more things wrong than right. So you only do this for a muni bond purchased at a premium. So, if I buy a muni bond at 120, remember in bonds peak, 120 is 120% of par. And so that's going to be 1,200. Now the IRS thinks you don't take your last buck and buy a muni bond. The IRS thinks if you have muni bonds, you have other things, which is correct, by the way. I don't take my last buck and buy a muni bond. So let's say this has 10 years to maturity. Now, one thing you should be able to tell me is that since this bond was issued, interest rates have gone down. So how does Dean know that since this bond was issued? Chat is open. And again, I just would want to give you a warning. This is my first warning. This is not an overtime session for people who have not participated in the live stream. So if you aren't participating in the live stream, tonight's fine. And maybe next week will be fine. But at some point, I'm not spending 45 minutes for free with people who are just showing up for the freebie. So make sure if you plan on getting more access to the overtime that you have participated in this evening's live stream. And again, Eric, I'll give you a warning. Don't just show up in the last few minutes. You should announce your presence because I'm looking for you. All right. So how does Dean know? Chat is open. Why? Just because it's my channel and I could decide whether I work for free or not. Doesn't have to be why. I'm a dictator as it relates to me giving away stuff for free. If that's what
Dean, be nice. I got on at 5:45.
Oh, okay. Well, just let me know because you're one of my favorites. So I'm just saying, where's Erica, right? All right. So how does I know? Chat is open. How do I know that the interest rates have gone down since this bond was issued? Test question. How does Dean
Trading at a premium.
Right on. So that's really important, right? What I'd like to do is buy the muni bonds and collect a higher than today's tax-free return. Right? Because this bond has a coupon that is higher than today's munis. Otherwise, it wouldn't be at a premium. And what I'd like to do is buy like 100 of these for $120,000. Right? And then hold it to maturity and take the $20,000 loss in one fell swoop whenever it's convenient for me. That's what I'd like to do. A lot of times the IRS says, hey, do it any way you want. But when I buy a muni bond at a premium, test question number one, the IRS says that I have to do straight line amortization downward. That I'm not going to be able to take this loss in one fell swoop. I'm going to have to take it in little itty bitty hits along the way. So I'm going to have to adjust my cost base by doing straight line amortization upward, or excuse me, downward. Okay, so this is kind of like a three-step question. It's about 50% probability whether you're going to get this. So the first point to answering this question is you have to recognize that this is a muni bond purchased at a premium. And then, you know, sometimes pictures are helpful. So here it is. I'm drawing a picture. And right, and this represents down here par. And here is what we paid for the bond. So, you know, maybe I say something like this. Question 17, 18, and 19 refer to the following. A customer purchases a muni bond at 120 with 10 years to maturity. How much must the customer decrete each year? Decrete or amortize each year. Again, this is my word, but accretion is going upward, decretion is going downward. Right. So here I'm going downward. And so I'm going to have to do $200. I'm losing $200. Let's get into a bigger font here, over 10 years. So chat is open. So if I'm losing in this muni bond $200 over 10 years, how much do I have to decrete each year or adjust my cost basis by? That's test question number one, by the way, because if you can't do that, then you can't come up with the answer. Right? Yeah. So $20 each year. So that's what we're going to write down. Each year is $20 a year. So that means at the end of the year one, that's going to be $1180. Right? So now they say on the test question number two, after holding it for X number of years, after holding it for X number of years. So maybe on the test, I say, we've held it for 6 years. And so if we've held this bond for 6 years and we're supposed to be writing off $20 a year, that means what we should have written off already is 120. We're adjusting our cost base downward by 120. So how'd I get the 120? I took the 6 times that $20. And so that's how much I'm going to adjusted cost base after 6 years. And again, we're still not done. So yeah, remember my original cost base was $1,200. Cost base is just the fancy word for turning the investment into money. So if I had a cost base of 1,200 and I've adjusted this by 120, what is my adjusted cost base? What is my adjusted cost base? So test question number one, a customer buys a muni bond for 120 with 10 years to maturity. Test question number one, how much must we decrete each year? We came up with 20. Test question number two, after holding it for 6 years, what is the customer's adjusted cost base? And the adjusted cost base here is going to be that is our adjusted cost base. Right, so yeah, 1,200 minus, oh, did I do the math wrong? You're correct. Look at that, caught the teacher, good job. You are correct. I'm terrible at arithmetic. As you know, Eric, I should have used my calculator. That's what Dean gets for not using his calculator. I told you I'm terrible at arithmetic. I should have used the calculator. 1,200 minus 120 is indeed, would you believe I did that on purpose just to see if you were paying attention? So that is our adjusted cost base. Now, the last test question is the customer sells the bond. And that's kind of confusing because if you miss this completely, like maybe I sell you, say your customer sells the bond for 110, which in bond speak is $1,100. And if you miss this completely, you're going to say, oh, I got an easy question here on my exam. I bought it for 1,200 and I sold it for 1,100. And so I lost $100. And your adjusted cost base was 108 and you sold it for 1,100. And so you actually have a $20 gain. All right, so let's just reset. There's about 50% probability on the Series 7 that you'll have to do this. Half the time I'm doing repeat people, I saw it. So your customer buys a muni bond for 120. That's important in bond speak. That's 120% of par. That's $1,200 with 10 years to maturity. This is given information. And you say, okay, this is a muni bond purchased at a premium. If it's another bond, you can do it any way you want, but not with a muni bond at a premium. Well, he said, okay, we're losing $200. We're losing that $200 over 10 years. So we're going to have to adjust our cost base $20 per year. That was test question number 1. Test question number 2, we've held it for 6 years. What is our adjusted cost base? Our adjusted cost base is 108. We sell it for 110. We got a $20 gain. Woohoo. All right, let's see. So our next thing in our list here is accumulation. Okay, simple mom on the live, Carol. Cool. All right, so let's clear our whiteboard. I don't think there's too many questions about accumulation units to annuity units, but accumulation units is when I'm doing the accumulation phase. So, when I buy a muni bond, this is 312, 12 minutes.
Is this for annuities?
Yeah, no, I know. Yeah, I'm just trying to get better at making my timestamps as we go along, because otherwise I spend hours afterwards trying to put in the timestamps. And, so that's a little reason why I get a little frustrated sometimes with the free stuff, because it really takes me a lot of time to make this the way I want it to be. So I just take a break to write 12 minutes and we discuss this so I can clip it and say that's where you could find this. All right, so we're in the variable annuities. There are about a half a dozen questions about variable annuities potentially on Series 7. This is also potentially tested on the SIE, and it's also on the 65, it's on the 6, it's on the 66. So the first thing I think about, and what Dean thinks about, is not testable, but I think of as a variable annuity as a mutual fund with an insurance wrapper. A mutual fund with an insurance wrapper. Don't tell a compliance officer I said that, because they'd be upset with me. But remember, when you're funding a variable annuity, I'll just make up a number. Let's say we're going to put $100,000 into a variable annuity. I just made that up. And remember what that word is? Remember what the fancy word is? What do we call that $100,000? I just turned my $100,000 into this variable annuity. And this is non-qualified. This is non-qualified. That's an important word. So what does that mean?
Pre-tax.
No, it means the opposite. Non-qualified means after tax. So this represents my cost basis, because if it was qualified, I would have no cost basis. So this is called my cost basis. And the reason that's my cost basis is because I'm using after-tax money. And you're absolutely right, Cynthia. Suitability, you shouldn't be doing this until you've maxed out every other retirement plan available to you. Now, the good news about that $100,000 I've already paid taxes on, this non-qualified variable annuity, is that represents my cost base. And now the money is going to grow tax deferred. And what I'm going to do is I'm going to put this $100,000 into a mutual fund known as a separate account or a sub account. And that's where we said this is becomes a securities product, because we're going to have this separate or sub account. And intellectually, what this is a mutual fund. So we're going to deposit $100,000 in there. Now, if it was a mutual fund, what would my $100,000 had have bought me if this was a mutual fund. This is a mutual fund, but we just call it a separate account. But if it was a mutual fund, what would that $100,000 have bought me? What would that $100,000 have bought me? X number of shares, right? X number of shares. So this $100,000, we would divide it by the public offering price, and that would be how many shares we would get. But in a separate account, these are called accumulation units. And it's just like shares in a mutual fund. So I call and say, hey, your $100,000 bought you 8,000 accumulation units. And a lot of times your variable annuity questions are simply just camouflage mutual fund questions. So for example, let's try one. How often does the insurance company have to calculate the value of an accumulation unit? How often does a mutual fund have to calculate the value of an accumulation unit? Just like a mutual fund, once per business day, right? Once per business day. Now, what you would hope would happen with this variable annuity, this separate account, you are assuming investment risk, by the way. In a fixed annuity, you would not. So, you know, one of my all-time hate questions is, why would you buy variable annuity? Because it has inflation protection. And in fantasy land, yes, but only as compared to a fixed annuity. But, you know, fixed annuities, remember, you're going to have that risk. So we're hoping this thing grows, right? We're hoping that mutual fund grows. The value of the accumulation units, you know, I can feed it too. I can put more money in there if I'd like. But let's now say I'm 59.5. That's important. Why is 59.5 important? Yeah, because
10% penalty.
yeah, that's exactly right. That's true of all of them, right? So, you know, on these numbers, you kind of got to be a little careful. So now Dean is 59.5. And let's say now I have $1 million in there. Woohoo. That's now the value of my separate account. And who knows how many accumulation units if I fed it. I might have more, but you know, if I had 8,000, I didn't feed it anymore. I would have 8,000. Now that's great news here, because unlike a mutual fund that has grown tax deferred. So over this period, let's say I invested when I was 39.5 and now I'm 59.5. And so this was 20 years that this has taken to go from 100,000 to $1 million. So it's been growing tax deferred. Kind of cool, because a mutual one, that's not true unless it's in your, you know, in your retirement account. So it's been growing tax deferred. And this is kind of interesting because there's a lot of things we can do. A lot of things we can do at this point. So one thing we can do is just say, hey, I'd like to take a distribution. So, you know, one thing I can do is take a distribution of this money, say, hey, I want some money. And the easiest thing would be to say, Dean, send me my $100,000 or my $1 million, excuse me. So you could do a lump sum. Okay, pay attention. This gets pretty testable pretty quickly. If I send you that $1 million, you're going to owe ordinary income tax rates on $900,000. So how did I come up with that you owe ordinary income tax rates on $900,000? That's the difference between your 100,000 and your $1 million. And you say, geez, Dean, if I had done that in a stock, it'd be a long-term capital gain. I go, yeah, this kind of sucks that this is going to be taxed at ordinary income tax rates. Right? That's all retirement plans, by the way. When you go to get distributions from them, the money coming out is going to be taxed at ordinary income tax rates. So the 900 is the difference, right? Oh, you say, well, Dean, I don't want to do a lump sum. I don't want the $1 million. Never mind. I want to do a random distribution, a random withdrawal. Just send me my $100,000 I originally put in there. This is very testable. Now, whenever you get a tax question, you get stuck. You always want to guess what yields the most to the U.S. Treasury, right? So you say, send me the 100 I pay taxes on. I go, no, test question. It's LIFO. Last money is in, or first money is out. That is very testable, right? So, you know, a couple of times, you know, LIFO and FIFO show up on the test. And this example is going to be LIFO. Now, the other neat thing you can do is you can annuitize. So if you don't want to get a lump sum, you don't want to do a random distribution, random withdrawal, the other thing you can do is annuitize. Now, this is a part of your question. You say, Dean, what is the difference between accumulation units and annuity units? And when you annuitize, you turn this into an income stream. So that's what you're saying. When you annuitize, you say, I want to turn this into an income stream. That's one of your choices. You can't do that with a mutual fund. You can't turn a mutual fund into an income stream that you can't outlive. Right? So the income stream, once you annuitize, we're going to change your accumulation units now become annuity units. So it's just an accounting function. So now I say, okay, we're going to turn your accumulation units into annuity units. And you say, well, what's that matter? I said, well, because we're going to have an assumed interest rate, and the assumed interest rate is going to determine what you're going to get paid each month. And you say, well, Dean, what's the assumed interest rate? I said, well, I don't want to tell you because it'll just confuse you. I'm joking, but that's called the error, the assumed interest rate. I'll just make up one. Let's say it's 4%. And so you have turned this into an income stream. And now you don't have accumulation units. Your point. Now you don't have accumulation units. What you have now are annuity units. And your check is going to go up or down by the amount of an annuity unit. Right? That's how they go up and down. So you call me and you say, Dean, I got my first check. It's $2,000. I say, great. I say, so that was your first check. You're getting paid monthly because you're in retirement typically. I say, then listen, next month chunk is either going to be more or less than that. By the way, if I told you a new unit was the value when we annuitize, turn these accumulations units into, I'll just make up a number, $50. That's how much the check is going to go up or down. I don't think that's testable, but so next month check is either going to be $1,950, $2,000, or $2,050 based on the assumed interest rate. So you say, I'm not sure I get it. I go, well, that's okay. Nobody ever does. So, just give me a call. And you say, Dean, I got $2,050. So the next check is $2,050. And so that means we did better than the error. Be careful, ladies and gentlemen. It doesn't matter if we beat this by 4.1 or 5. It doesn't matter. If we do better than the error, the check goes up. So it doesn't matter what the numbers are in the question. So just be careful. What I mean by that, better than 4%. Again, I wouldn't get too hung up on the interest rate, but the assumed interest rate. But what I mean is, even if this goes to maybe let's call this 8%. I'm just making the number up. So we got 8. That's better than 4. Check went up. And the trick on it is that it doesn't matter if this goes to 4.1. And you say, oh man, it went down. I go, no, 4.1 is better than 4. So the next check would be $2,100. My experience has been nobody gets this until they go down. So let me just tell you, the next return was 3.9. Chat is open. So the next check, the next return that we received was 3.9. So if the error is 4 and the return was 3.9, what does the next check look like? So we've got the fourth check is coming. My question is that next check going to be higher or lower? Higher or lower? Yeah, it's going to be lower, right? By the way, please note that's still positive performance. It's just not better than that. Right. So
can I ask a question?
Sure, of course.
So on this, we don't necessarily know how much it's going to go up or down by, we just need to know that.
Yeah, exactly. You don't need to know the 4 or the 8. Yeah, you just need to know to be able to tell me the check goes up or down.
Okay, great.
Based on the error. So that's what you got to be able to do on the test, indeed. All right. Any other questions on this thing? Diego, how do you avoid getting confused about LIFO and FIFO? I don't know. It's just memory work. Let's just review it right now. So LIFO would be in the situation I just told you. Chat is open. Anybody help Diego? What would be FIFO on your exam? Anybody know what FIFO could be the right answer to based on pre-study? FIFO could be when you're doing dollar cost averaging in a mutual fund, or you're buying shares over different time periods. And so when you're buying shares over different time periods, you can do share identification. You could do average cost. But Diego, if you can't identify which shares you're selling, then the IRS test question will impose on you FIFO, the first shares you bought are the first shares you're selling. And that'll generate a bigger tax, Diego, because more often than not, the first shares you bought are the ones you have the lower cost base, right? So that's what that's about. There's one more FIFO. Anybody I know the last FIFO I'd be aware of as a test? Random FIFO or another fair method. We'll play Jeopardy. You know, what is the question if that is the answer set? Random FIFO or another fair method? Random FIFO or another fair method? No takers? That would be the firm on exercise notices to customers. So, you know, the OCC does it randomly. And then within, I'll just say Merrill's client base, they probably have more than one customer who is short that particular series. So how does Merrill decide which one of its customers is going to have to come up with the stock, if it's short call, or come up with the money if it's a short put? And the firm test question, get a random FIFO or another fair method. Now, if you're getting good as a test taker, what can you expect as a test taker when you have three of a thing? What could you expect when you have three of a thing? Yeah, they just love that accept format. It's one of their all times, right? So you could expect to see this kind of a question as the accept format. A firm can assign exercise notices to its customers and all the following methods except, and then D would be something that would be not fair. So Diego, those would be the scenarios, I think, where you can encounter LIFO and FIFO. You know, we always reference the content outline. And if it's in the content outline, Diego, it is fair game to ask you about it. It is fair game to ask you about it. But in that situation, the only other thing that's on the content outline, but I've never had anybody on debrief tell me they've seen it, is about inventory and valuation of inventory. So if we're a retail business and we have inventory, we could do LIFO or FIFO in terms of our inventory. And Diego, if we're using the last in, first out, we'll have bigger profit margins, right? Because typically the stuff we bought long ago has a lower cost basis. In FIFO, we would have smaller margins. All right, let me see if I missed anything in the chat. Sometimes when I open the chat, you guys answer that it takes up whatever is there. Okay, so Eric, I think I took care of your muni bonding on decretion. Let's see, I took care of Cynthia, suitability. Is that just I'm not sure what you mean by suitability. Maybe you just were answering something in the chat. Eric, appreciation. Yeah, that was called appreciation indeed. So our dividends and interest tax is ordinary income. Lisa, it depends on the dividends and it depends on the interest. What I mean by that is, Lisa, what exam are you taking? You can put it in the chat or you can unmute, whatever you'd like. Yeah, Erica, maybe we catch me on a good day, Erica. When you catch me on a good day, maybe I'll make it a marathon session. I'll prove I have the stamina to go forever.
I'm taking the Series 7.
Okay, so I don't think you'll see this on the Series 7. In most circumstances, well, let's just distinguish this. So let me get a quite clean whiteboard again. So we'll start with the dividends. So you're going to get dividends from stock, right? And you're either going to get a cash dividend or a stock dividend. So cash dividends are taxable as ordinary income on the 7. There is an exception to that. And the exception, I think it's more of a 65 question, but we have what are called qualified dividends. And if you've owned the stock 60 to 90 days before the record date, you would get a lower tax rate. I wouldn't worry about that on the 7. I would just know that the dividends are taxable and they're typically going to be taxable to ordinary income. But if you're taking a 65 or 66, I would be able to make that distinction. Not that in 60 or 90 days, just say it's going to be qualified for a lower tax rate, a qualified dividend than unqualified. Unqualified would be taxable at your ordinary income rates. And the stock dividend is not taxable. And in a stock dividend, what you have to do is adjust your cost base. So for example, if I bought 100 shares at 50, remember this is called my cost basis. And so my cost basis is simply, again, when I turn that investment into money. So anybody know what we're going to have to do if we get in my example, a 10% stock dividend?
Split.
Well, it's not a split, but it's very similar. So if this is a 10% stock dividend, well, I got to be able to say on the test, how many additional shares am I going to get? Right. And so you have to be able to tell me on the test that I'm going to get 10 additional shares, right? 10% times 100. So now I have 110 shares, not taxable. But what I have to do is adjust my cost base. So now what I'm going to do is I'm going to divide that 5,000 by 110 shares. Most of the time you can get over on this by just knowing that it's more shares at a lower price. Now I will use my calculator because Dean didn't use his calculator last time and I got myself in the low hot water. So now I'm going to take 5,000. I'm going to divide by 110. I think the good thing to remember is you always have more shares at a lower price. And then you just would have to pay taxes when you sell, when you realize the profit. So that's my adjusted cost base per share. So that takes care of cash and stock dividends. Now, again, the answer is the same on Lisa, the interest, because it depends on what kind of bond the interest is coming from. So on the test, remember, we have three issuers of bonds. We have corporate issuers, we have municipal issuers, and we have the US government. So now, Lisa, it's going to depend on where the interest is coming from. So what kind of bond do you own in your portfolio? Just pick one.
Corporate.
So that's going to be fully taxable. What I mean by fully taxable is you're going to owe both the federal government and your state government. I moved out of California, thank God. California's top tax bracket is 13%.
Are they taxed at ordinary income then?
Yep, that's whatever your ordinary income tax rate is. Yep. So you might want to consider, instead of doing a corporate bond, what might you want to consider?
The best one, Muni.
Well, yeah, depending on your tax bracket, because if you're poor, it probably was not going to be as good a deal for you. But yeah, if you're rich, yeah, right. So the munis, they could be taxed on the federal. They're going to be federally tax exempt. Now, I just brought up California. California could tax you on California municipal bonds, California or political subdivisions of California, but they choose not to. So California chooses not to tax you on California bonds. So if you're a resident of California, I'm coming to you from Las Vegas, and you buy a Clark County bond, California can and will tax you. Reciprocity doesn't apply state to state. So in terms of suitability, it'd be very important to find out where you live, because you might be able to get a bond that's either double or triple exempt. Double exempt means you're not going to have to pay taxes to the feds or the state, in my California example, right? You're not going to pay state or federal income tax. But, there are some cities that have city income taxes, like New York City, Philadelphia. And so you buy a New York City bond, it would be triple exempt. New York City won't tax you, New York State won't tax you, and the federal government can. So suitability is going to be very important. So let's say you're a resident of California. You say, Dean, I'd like to be able to diversify myself geographically. I don't want to put all my eggs in California basket. Is there a way to diversify a customer outside of their state of residence and still have it be federally tax exempt? Is there a way to diversify a customer's muni bond portfolio geographically outside of their home state and still have this double exemption?
Yes, in this territories.
You nailed it. That's very testable, right? In the territory they love is Puerto Rico. Puerto Rico, right? The federal government could tax you, but chooses not to give you an incentive to invest in Puerto Rico. California would like to, but can't. Boy, if anybody wants Puerto Rico to become a state, it's the other states. Please come a state, because then we can tax you. Right now, they're not going to give you U.S. Virgin Islands or U.S. Micronesia. You know, it's going to be Puerto Rico if you get that on the exam. All right, then our last one is the U.S. government. So you buy a treasury bond. So you're receiving interest from a treasury bond or a treasury note. Do you owe federal income tax at your ordinary income tax rate on the interest you receive from a federal bond?
Yes.
You certainly do. The U.S. government can and will tax you on interest you receive on treasury debt. How about your state? Can your state tax you?
No.
They can't. That whole thing, by the way, it's a little beyond the scope of the test, but it's called reciprocal immunity. That's the principle of why states can't tax you and the federal government can.
I heard you talk about that with one of your tutoring
Yeah,
people.
yeah. So yeah, I think it's beyond an overtime session. But okay, so well, just one more here that we should be aware of. So I had said you're held accountable for debt denominated security. Your question was about dividends and taxes, and we're going through this thing. The other one I'd be aware of is Ginnie Mae. Ginnie Mae. And you should definitely know, how is Ginnie Mae taxed?
Well, it's a federal one. So
It's
I guess
federal
you'd be
and
tested
state.
just with federal. Oh, it's state
No,
also.
yeah, it's state and federal, so it's fully taxable. So I would know Ginnie Mae is fully taxable. Fully taxable. Variable annuities, Zoom user. We got somebody who's anonymous. Zoom user. Varying maturities. Well, here we go. Right. I did a little short. I did in our live stream 6 test questions about what happened to our friends at Silicon Valley Bank. And one of the things that they didn't do, this is just poor banking, is they didn't have laddered maturities in their bond portfolio. This is more of a 65 test question than 7, but if we have a laddered bond portfolio, as interest rates went up, Silicon Valley Bank would have had in their bond portfolio bonds coming due that they could reinvest at today's high rates. And that's called a laddered bond portfolio. And again, the reason you would do that is to, there's 2 rates in bonds, interest rate risk and credit risk. It certainly wasn't credit risk that blew up Silicon Valley Bank, because the portfolio was treasury securities or government sponsored enterprises. What blew them up is that interest rates went up, their bond prices went down. They were forced to sell because they had to meet their everyday demand for banking, in this case withdrawals. And that's what got them on the test. Now, I'm not sure if you're asking about variable maturities being serial maturity versus that. Serial maturity is just a definitional question that the issuer has bonds that are coming due at different times. That's a different issue completely. And then on the 6507, I think 7, that's pretty much it. But on the 65, you might get tested on barbell, where you have short-term and long-term bonds. And you might get tested on that bullet strategy. But on 7, I think just laddered maturities would be it. And then a definitional question, no, series means different issuing dates, Lisa. And serial means different maturity dates. Okay. Nico's taking his SIE. Nico, I'm worried about your study materials, because you seem to have questions that remind. Erica is using past perfect. Oh my God. I will sing her praises, because I was concerned because she had a lot of past perfect questions that are like, oh my God, geez, this isn't going to be on your SIE. And you could go down on the weeds, and she was paying attention to making editorial decisions about what to do. So Nico, I'm not sure if you're using past perfect, but be careful, because you have a lot of SIE questions that are more 7 questions than what you're actually going to encounter on the SIE. Carol, I don't know what you mean by 10. Is that just an answer to something or something you want me to do? Nico, types of
That was an
corporate
answer. It was an answer to something.
Oh, okay,
For
cool.
the bonds, not the bonds, the shares, the 10% stock dividend.
Oh, there you
Sorry.
go. You're correct. You're correct. Thanks, Carol. Yeah, I always like people to participate. It's a little better if people participate. So thank you. God knows I don't want to listen to myself talk. Erica, if we skip a ball game, there is. Erica, I hate to correct you, but there's a Laker game. Lakers are playing the Pelicans tonight. And the Lakers have been playing pretty damn good, even without LeBron. So there is always a basketball game going on somewhere. Anyways, types of corporate bonds. So Nico, there's 2. This is testable on the SIE, and it's testable on your Series 7 as well, and 65. Anybody know the 2 types of bonds we have? We have secured bonds.
Secured and unsecured.
That's right. And so secured category, we have mortgage bonds. By the way, very testable to know these secured bonds are senior in liquidation. You know, capitalism without failure is kind of like religion without a hell. And the unsecured bonds are junior securities. What we mean by in liquidation. They're senior, always senior to the equity, but they're junior to the secured bondholders. Right. So we have mortgage secured by real property. What else do we have? Anybody want to help our friend Nico out? What are some other secured bonds besides mortgage bonds? Equipment trust certificate bonds.
I know,
Uh,
unsecured, I know,
Well, hold on, let's finish this one up. Let's finish this one up. We have one missing from this list, Nico. Anybody want to, can tell us what our last one is? In the secured category? Collateral trust bonds. And then I would know what the underlying security is. So in the mortgage bonds, Nico, the collateral is the real property. In equipment trust certificates, it's the major movable equipment, you know, airplanes, for example. And collateral trust bonds, it's marketable securities placed in escrow. All right, so now unsecured bonds, we have debentures. And this is just the issuer's promise to pay, right? We have debentures, we have subordinated debentures. These are debenture holders that are subordinating their claim to the regular debenture holders. We have a little bit of some hybrids here. What is one of the hybrids we have? We have rag tops. We have convertibles. I think it might be a bad draw, particularly on SIE, but we also have income or adjustment bonds. So convertible bonds allow you to switch your status from being a bondholder to being a common stockholder. The only thing you would need to know on your SIE is to be able to calculate what's called the conversion ratio. Now, Nico, when you come back for your 7, you're going to have to be able to calculate parity. But for your SIE, you just need to know conversion ratio. Income or adjustment bonds only pay interest when and if earned. And those are used in bankruptcies and restructurings.
and how would I calculate the conversion ratio?
It's based on par. So let's just do one real quick. Let's say on the test, I tell you the conversion price is 40. Right. So the way you get the conversion ratio is you take par. What's par in a bond?
1,000.
Yeah. And so you take that 1,000 and you divide by 40. And that would give you the conversion ratio.
Okay, pretty simple.
Yeah. Yeah. You know, as long as you don't freak out. Right. And if you're taking a 7, you would have to be able to do that with a little more. There's a little more you'd have to do on the 7. You have to be able to do parity and tell the customer whether you should convert or not. So a little more into it. Okay. Anything else here? We're at our 45 minutes for our overtime session. So anybody got anything else?
For section 2, for the SIU.
Yeah.
What are the 2 most things you would have to distinguish the difference
Well,
between?
I don't know what section 2, I don't have it in front of me. Is this your content outline you're talking about, Nico, or what?
Understanding products and their risk.
Oh, well, that's 33 questions. The way I would attack that is print your PDF for the content outline from FINRA. And you can watch me do this as in video form where I can just go through that whole document, but that is 33 questions on your SIE. And so just go through that. And I would do what I call a plus minus debrief. Just go through it and look at each thing and put a plus if you think you're above par in understanding it. A 0 means you're at par. You know, par, by the way, is passing the exam. And then below par and things to work on. So that's how I would go about seeing what's important and confirming that with whether Kaplan or Past Perfect or STC. But remember, that is the biggest section of the securities industry essential. It makes sense. Securities are the most important part of the securities industry, right? So that's the stocks, the bonds, the mutual funds, the options, you know, ETFs. So that's where the action's at. And then remember, we pulled, I think in our I think you won the coaching call, I believe, Nico, and that's what we did, right? We pulled some questions from that section.
Yeah, and I was looking over that one and I saw the one where we looked at if it's not taxable in your state, but taxable like federally.
Mhm.
And what is that one again? If that's something that's outside of your state, correct?
Yeah, that's correct. So very important. This is called know your customer. And two of the most important things is to know, where is my customer resident of? And physical addresses don't determine residency. This is really important for suitability in a lot of things, because Nico, when you come back for your 7, we have a Rule 147 intrastate offering of securities. And to participate, you have to be a resident. It's also important what we're discussing in terms of muni bonds. And so what determines your residency is where you vote, where you pay taxes. So, right, that's where you're resident. So that's important. Then the second very important thing about know your customer suitability is, what is your tax bracket? What is your tax status? Right. So I say, Nico, for me to do a really good job for you over time, I'm going to need to know a lot about you. And he said, well, that's none of your damn business. I go, well, it actually is. My regulators say that I can't make recommendations to you unless I know something about you. And I certainly can't make a recommendation about an intrastate offering of securities or munis if I don't know your state and I don't know your tax bracket as it relates to munis. So those are really important. I think somebody else was trying to get in. Anything else before we call it a night on the overtime?
Dean, I did have a quick question for you. I was looking at Brian's Test Geek information on suitability.
Yeah. Mhm.
He did have like a 12 questions supplement on just regarding some of the suitability questions and a guide to answering them. I wanted to know if you already had a video doing like an explication.
I have a whole
on some
playlist
of
called
the-
suitability. I have 4
Okay.
videos.
Oh,
It's,
okay.
I have one called, I have a suitability practice exam. It's like 50
Mhm.
questions. It's one of my most popular things. It's like 20,000 views. I have a suitability in 60 minutes. That was the first of my 60-minute kind of series I did. And then I have a suitability exercise that it's, Kaplan gives me permission to use Kaplan content. And I have a Kaplan exercise that is in the appendix of Kaplan content. And then I have the 4th one is what's clearly unsuitable. So I have the 3rd one is what is suitable. And then the 4th one is not suitable. And they test you on both of those. So it's a separate playlist. I think the title of the playlist, it's on the homepage, is called "Is Your Series 7 Recommendation Suitable?" Yeah. Are you taking a Series 7, I hope?
Series 7, yes.
Okay, cool. By the way, even if you're not, you could still watch it. Nico, for example, wouldn't do any harm to watch that, because it's the options would be a little overkill, but yeah, most of it's still the same stuff. Our REITs test, well, they certainly are, Lisa. REITs you would buy for the same reasons you buy a mutual fund: professional management, diversification, ease of ownership. So very testable why you buy them. And then a REIT, like a mutual fund, does not pass through losses. Very testable. What do REITs pass through? And
Gains.
pass through? Yeah, well, you're
Gains.
right. Capital gains distributions. I'm looking for test question 90%.
90%.
Yeah, very testable. 90%. Sure, we can do whatever you want in your coaching session. So if you want to do suitability, that's fine with me. So we'll pick the time. Like I say, it's coaching sessions or whatever you want to do. I think when Erica won, I think she wanted to do multiple option strategies, as I recall. So it's whatever you want to do. I'm usually pretty good if I don't have a hard stop. Like at Nico's, I went over, and I think in Erica's, I went over. So if I don't have a hard stop, I'm usually, okay going past 30 minutes. Don't count on it, but depends on what day you get me.
So why
Any-
would someone buy a REIT versus a mutual fund?
Well, REITs are a nice liquid way to own real estate. For example, I used to own for many, many years. I owned 1,000 shares of what's called Boston Properties, BXP, trades on the New York. And I bought it when the Rockefeller sold the Embarcadero in San Francisco to Boston Properties for stock at $20 a share. And I said, good enough for the Rockefellers, good enough for me. It had a very competitive yield, right? Very competitive yield. That's one reason I bought it. And it was diversified to get a diversified portfolio of real estate, unlike a partnership, which is illiquid. And at the time, it was a guy named Mortimer Zuckerman who was the guy running it. So I get professional management. So it's a way to buy real estate in a liquid form with professional management and diversification. We have to be a little careful nowadays because we have what are called non-traded REITs. And those are a little more of a suitability issue, right? Because those you can't get out. And my Boston Properties, for example, when David Rockefeller sold his Boston Property stock, I sold my Boston Property stock. I'm like, Okay, if he thinks it's time to get out of his REIT, I do too, right? So that's why you would buy a REIT. It's a liquid way to own real estate.
Will
Is
non-traded
it
rates be on the
considered-
exam?
It's very testable. Everything I just told you is testable. Are we clear?
Is
REITs
it-
are testable. You need to know
Is
why
it part
somebody
of
would.
the Investment Act of 1940 and
Well, that's
a
not the test.
primary?
question. No, that's not the test question. The test question is, why do people buy REITs?
Oh.
Professional management, diversification, ease of ownership, liquid way to buy real estate, assuming it's a traded REIT, non-traded, and then this 90%. And you got to be able to contrast it in a mutual fund with a partnership. It doesn't have a flow through of losses. So you got to know how it's different. It's very testable. I can't imagine any draw of any exam in which you don't get at least one question on a REIT. Anything else?
Yes, Dean, I put in a request for a debt class. Is that gonna be on the horizon anytime
Excuse
soon?
me? Yeah, I'm thinking about it. Hold on, I gotta answer. Mom's calling. Yeah, Mom. Yeah, yeah.
What do you want?
I'm okay. I'll get something.
Okay.
I'll get something out of the freezer.
Okay, I'll
Okay.
be home in a minute.
All right, bye-bye. Mom's getting old enough. I make her call when she's leaving her senior things. I know when to expect her back at the headquarters, right? Erica, I'm probably gonna do the bond one. I'm probably gonna do the economics one. I just gotta figure, when's your test date, Erica?
To be determined, but I want to be ready, Dean.
Okay, well, I would prefer to know your test date. I always think it's better to have a test date, but I think I'll try and do that for you.
Okay,
I'll just have my permission to nag me. And
done.
yeah, no, I'll tell you what I'll do, Erica. Maybe I'll even tonight put it on the schedule for you.
Woohoo!
Yeah, I think I'm probably better than having you nag me. Probably just suck it up and.
Hey, Dean, last question. There's a phone number on your tutoring site. Do you answer that thing, or is that
I do.
text only?
Yeah, no, that's my bat signal. I mean, I'm gonna get pretty aggravated if you're calling me and you're not booking tutoring, but the number works. Yeah, I answer my phone. So
Okay.
yeah, better to do Zoom. Okay, so anything
So
else?
my exam's on this 20th.
The 20th. So Nico,
Oh, yeah.
so Erica and Nico, the other reason I'm considering doing Nico is because that lecture or that class, if we call it a class, would be good for the SIE as well as the 7. So I'm trying to do ones that, are the next one that is appropriate for everybody is types of orders. And I'm charging $35 for that. And that's the cheapest way to access the free stuff, the office hours. And I probably should apologize to you, Erica, because I think the deal I originally made was if you are a paid alumni, which you are, that I would allow you into anything, I think was the deal I made. Is that the deal I made? I think that's the deal I made. So for those folks, I don't think you should have to participate in the live stream, but if you're just hanging out for a freebie, then I think you should have to participate in the live stream. I appreciate your patience as I'm kind of making this up as I go along about, what it looks like. So, I told your Calvin call, like, what are you doing with these evenings? I'm just seeing what's out there. Part of it is I told you, Eric, is I don't want to have channel memberships because I want the channel to be free. And I think it gets to be complicated about what I would charge you for and what I wouldn't. So I just think it's cleaner to charge you off the channel for this kind of stuff or this free stuff rather than trying to do that through YouTube. So that's kind of my idea. Anything else?
Dean, I just have one question. My
Yeah.
company works with Past Perfect, and like we have access to a lot of their instructors. Can I ask one of their instructors for permission so maybe we can go through like a Past Perfect, like a suitability quiz? Would that be
Oh,
okay?
if they give me permission, I'm more than happy to do that. I've got permission from from Notman. So Nico, Thursday night, I got permission from Notman to do one of their exams. I have permission from Kaplan, Momentrix. So yeah, I'm more than happy. Past Perfect gives me permission. I'm more than happy to do that. They'd have to
Okay,
give
I'll
me
go.
permission to record it too, though. I got to be able to record it and put it on my channel. And that could maybe be an issue for them, but I love that. That's one of our favorite things people like is doing those kind of exams. So
Okay, great. I'll go ahead and ask them
yeah,
to
if you,
get
well,
back
I'll
to
tell
you.
you what.
Thank you.
I'll be very impressed if you can get them to go for that.
All right, I will. I'll
And then
try.
remember, I told Erica the same thing. You Past Perfect people. I think we need to form a support group for you guys because
I know.
I mean they really, they have some really tough questions for sure. Anything else? Yeah, I'm with Erica. I don't think it's going to be likely, but hey, we can always hope.
I'll make sure to email you if I have any questions.
Yeah, Nico, the easiest way, like Erica does it too, a lot of people do it, if you're using Kaplan or not, even past perfect, you need to screenshot it if it's STZ or past perfect, because I can't see it backstage. But if it's a Kaplan question, you can literally just send me the QID and then I can bring it up and I can see what you're looking at. So it's always easier for me to help you out on a Kaplan question. For example, who was it that was 1263897? Are you still here? Was that you, Erica, or was that somebody else that brought up that QID?
Oh, the
No,
Kaplan,
that-
that was me.
Oh, okay. So yeah, so that's easy because, you know, as soon as mom gets home and I chat with mom, I'll either do it tonight or tomorrow and I'll make you a little video and then I put it on the channel. So it's just easier if it's a Kaplan question. I'll help you with any question, but Kaplan's easier. And then, you know what, to be honest with you too, I'll try and learn how to put up my Kaplan screen I can do it on the Zoom, but you know, when I'm doing it, sometimes I go out of it, then it wipes out the Zoom session. So. Okay, there's nothing else. Last call.
Thanks, Dean.
You bet. Inch by inch, your exam is a cinch.
Yard by yard.
Your exam is hard. And I think our office hour, Erica, is Monday. Is that our next office hour? I think we
The
got
20th.
the 20th. So I'll see those of you who are in the office hour. I'll see you then. Bye-bye.
Have a good one.
Thank you.